How's it, traders? Welcome back to Paradigm Flip. Hope you're all doing well. Yeah, on the chart we got the VIX and the S&P 500, and we just want to be looking at what we can expect from the S&P 500, right, or other indexes uh, in the equity market going forward. Okay, so when we are actually looking at indices, right, or equities, right, we want to actually not look at it in isolation. We want to actually look at the VIX along with the S&P 500. So at the top here we have the VIX, right? And at the bottom panel we have the S&P 500. And you're going to be using these two charts together, right, to make decisions going forward, right? Now, what is the VIX? The VIX is basically the 30-day implied volatility of the S&P 500. When we are actually looking at the implied volatility, right, what we are actually looking at is the gauge of fear within the market. And when the implied volatility rises, right, that's indicative of increasing fear in the market, and as a result, the US 500 drops off, okay, and when the implied volatility drops, right, that's indicative of less fear in the market, and as a result, equity prices rise. So it'll also be the same on the Nasdaq, and it'll be the same on the US 30 or whatever other index that you're trading, okay, because they're all correlated. And when we are looking at the VIX, right, it's going to give us very important information that can help us going forward, right, when trading uh, any index that we're trading. So in this situation, we are using the US 500, right? But if you want to add Nasdaq or whatever you trade, right, it's going to be exactly the same, right? So we can actually use the VIX, right, because the VIX can give us some insight, right, based on the nature of how it moves, right? And the first thing we want to do is understand how these markets are related. And you'll see that if I just bring up this panel at the bottom, you'll notice that this is basically a correlation coefficient, right? So it is the correlation coefficient um, between the VIX, right, and the US 500. Okay, so basically it's telling us how correlated these two charts are. And what you'll notice is that there is a very strong negative correlation, right? And this can be seen going back throughout history, okay? It's always been like this, and it'll always be like this going forward. And because of that, okay, we know that with confidence, okay, that whatever the implied volatility is doing, right, it's going to be negatively correlated, right, to the S&P 500. Okay, and this can be helpful because if you actually look at these two charts, they actually are different, right, in nature, right? And you'll notice that the VIX, right, is very rangy. Okay, so you can draw brackets over it, and basically it is a mean reverting chart, and that's because volatility itself is mean reverting in nature. Okay, so you get ranges, right? Volatility expands and then it contracts, and then it expands and then it contracts, right? And you'll notice that throughout the history of the chart of the VIX, right? That's the case, right? And occasionally you'll get these big spikes, right? So this was the COVID-19 crash, okay? That spike in volatility, right? There was a whole lot of fear, right, being priced into the market, okay? And you can see that the S&P 500 tanked, right, along with that rise in implied volatility, right? And when you usually get these spikes, it's not going to last forever. Okay, there's going to come a time where the volatility is going to normalize. Okay, and as a result, you can see that the S&P 500, right, bottomed right around the same time that the implied volatility started to drop. Okay, so these spikes are outliers. Okay, and they don't usually happen. Okay, and if we just go back in time, you'll notice that these spikes occur, right? But what is more frequent than these spikes is basically, right? So if you look at the historical prices of the VIX, right, you'll notice that these spikes occur, okay? but they basically are outliers and they don't occur all the time. Okay, we do have miniature spikes, right, in these areas, right? And this is a bigger spike, right? But nonetheless, they are all spikes in volatility. But what always happens is that after we get a spike in volatility, right, volatility contracts. Okay, because that's its nature, right? And basically, these are outliers, right? So what we basically see, what we usually see is that uh, the volatility, right, trades within ranges, right? It trades within bands of price, okay? And it stays within these ranges for quite some time, okay? And right now, right, this is the current range that the VIX is trading within, okay? And we've been in this range for quite some time now, as you can see. And you'll notice that although we have a very strong negative correlation between the VIX and the S&P 500, what you'll notice is that these two charts are different, right? The VIX is a very rangy mean reverting market, right? Or chart, and basically the S&P 500, right, has a positive drift, meaning that it slopes upwards, okay? And this is very interesting, and because of this, we can actually use the information on the VIX to help us, right, with trading ideas going forward on the S&P 500, right? And the way we can do that is that if we draw our range, right, which I have here in pink already, right, of the VIX, okay, we know that at the current moment, right, that the VIX is within this band, right, of these two pink horizontal lines, right? And if we also know that these two charts are negatively correlated, okay, and we've identified the characteristics of the VIX, okay, we can actually use this, right, in the S&P 500, right? So whenever we get a move to the top of the range, right, we can expect a mean reversion, right, of the VIX, right, and we can expect it to trade back down to the bottom of the range. Okay, and when this happens, okay, we can expect the S&P 500 to actually be bullish. Okay, and if I just line these up, okay, if I just zoom in here, right, and I just line up, right, these areas, right, you'll notice that when we reach the top of the range at this point, right, we saw a mean reversion on the VIX back to the bottom of the range. And at the same time, S&P 500 rallied, okay? And once we reach the bottom of the range, right, at this point, we could expect a move back to the top of the range, okay, right? And at this same point in time, we saw a drop in the S&P, and we reached the top of the range, right, yet again, right? And at this point, we can expect the VIX to actually mean revert, and as a result, S&P to rally, and that's exactly what happened, right? If I just line up those um, bottoms and peaks, okay, and then we reached close to the bottom of the range. So at this point, we never reached exactly at the bottom. We reached close to the bottom, right? And it's never going to be that perfect, right? But we have to deal with an imperfect market, okay? And what we get here is the VIX trading back to the top of its range and the S&P 500 falling, right? Now at this point, we could have anticipated the VIX trading lower, right? And a rally in the S&P 500 and so on and so forth. And you can just see that throughout time, right? You can see that in this area, we formed a little smaller range, right? And basically the VIX was trading within this smaller range and we didn't really reach the bottom of the range, but we did reach the top of the range again, right? Around this point, right? And you could expect, right, that price on the VIX to revert back to the mean, right, and perhaps trade back to the bottom of the range, right, and as a result, you can also expect the S&P 500 to rally, okay, and when we reach the bottom of the range at this point, we can expect a move higher to the top of the range on the VIX, and we can expect the S&P 500 to drop off at that point, and you can see that's exactly what happened. Now we are here in time, and VIX is once again at the top of the range. Okay, so we can actually expect a move away from this high, okay, on the VIX, right? And as a result, we can actually expect a move higher on the S&P 500 going forward. Now, it's important to note that nothing in trading is guaranteed. Okay, so this is not financial advice, right? But it's what my thoughts are and what I'm anticipating going forward on the S&P 500, right? And if we just look back in history, right, this is something that holds true throughout time. Okay, and if anything, if you are involved in any trend trading, right, on the S&P 500, if you are involved in this selling trend, okay, right, we've just taken out this low, this previous low, right? This is a level where we can expect buying to come in, okay? And based on where the VIX is currently, right, it's advisable, right, to be cautious going forward if you are involved in any selling, right? And perhaps anticipate buying to occur, okay? And always wait for confirmations and always um, be responsible with your trading, okay? All right, I'm being very careful not to basically tell you what to do with your trading. I'm basically telling you what I'm doing with my trading and what I'm looking at going forward with the S&P 500. So just make sure you get that straight, right? And basically, if you are looking for any sells, right, it's best to reduce the risk, okay, because of where VIX currently is, right, at the top of its range. It's very high probability that we will get a move lower on the VIX going forward, right, off these levels as it always has done, right, in the past. Okay, and we can also use other tools, right, other markets. We can look at other markets to help us actually validate this hypothesis, right? So if we just look at the dollar, right, in recent months, we've seen a negative correlation between the dollar and the stock market. Okay, and what you'll notice is that the dollar has actually created a high at this point, right? And we've traded lower on the dollar, right? And we are still sitting at the lows, right, on the S&P 500, right? And because we have created this high, right, we can anticipate that S&P 500 also makes a low, right? Because these two are negatively correlated, and you can actually just look at that, right? If you just look at all the peaks, right, and troughs within these two markets, right, they line up, right, almost symmetrically. Okay, so whenever the dollar makes a high, the S&P 500 tends to make a low, right? And sometimes not immediately, right? But subsequent to the dollar making a high, the S&P can make a low, or vice versa, right? And every time S&P makes a low, every time the dollar makes a low, sorry, right, the S&P makes a high. Okay, right? And you can see that going forward, right? The dollar makes a high, S&P makes a low, right? Dollar makes a low, right? The S&P forms a high, right? And so forth. So right now, dollar has actually made a high, right? And we can expect a low from S&P 500, right? And that would be the same on your Nasdaq, your US 30s, whatever indice that you're trading. Okay, so this is an important concept that you can actually use going forward, right? And when you actually see these things setting up, it can give you insight, right, on how to treat your trading going forward. Okay, so that'll be all from me today. I hope you learned from this, and until next time, cheers.